Hi guys. Okay, I want to go over the Chapter 16 practice midterm. Before I do that, though, I did have a question that came out regarding where is the guest speaker recording, where is the guest speaker assignment, and it's a little bit hard to find. It's under the course announcement and general description. Guest speaker assignment. You click on that and it gives you the information about what you need to do for the assignment. The recording is right there. The rubric for the final paper, which is basically the same information I posted up here, is there. You don't really need this anymore. That was the login for it. And then these are the slides that Danny Wallace went through. So yeah, so you've got those things there. Looks like one person has submitted that, so that's great. So don't forget that's due here towards the end of the term, so make sure you're not forgetting to do that, okay? That's what, 25% of your grade, so don't forget that. All right, good. So what I want to do, oops, getting back into the class here, is take a look at the practice midterm for Chapter 16, which has been posted. Okay. All right, good. So let's just go ahead and I've got that already loaded. And of course, got to do my little flip into tablet mode. Check to make sure I'm still recording, because there's nothing worse than getting to the end of my recording and see that somehow it stopped itself, or thinking I'm done and meanwhile I was talking to myself. That's recording, and so we can go ahead and turn our attention to these Chapter 16 questions. Now, as I was saying in the lecture, this gets a little bit rules based on some of these things, so it is going to require that you practice with these and be comfortable with these different questions now dealing with. And the two main topics are the conversion of bonds or preferred stock to common shares and how that'll be accounted for, and then how to deal with the potential dilute effects on our earning per share calculation. And so we'll look at some questions of that nature. Okay, let's go ahead and let's take a look at number one here. This Fogel company has $4 million of 8% convertible bonds outstanding. Each $1,000 bond is convertible into 30 shares of $30 par value common stock. The bond paid interest on January 31st and July 31st. On July 31st, the holders of $1.280,000 of bonds exercised the conversion privilege. On that date, the market price of the bond was 105. The market price of the stock was 36. The total unamortized bond premium at that date, at the date of conversion, was 280,000. Fogel should report as a result of the conversion. It asks for debit credit. Really, they give me just choices on credits here. And then it talks about a loss of $12,800 as one of the choices. Now, as I said in the example, or in the lecture, I should say, there are no gains and losses on these conversions. Okay? All we do at the time of conversion is figure out how many bonds were converted. We take the bonds off the books at that point in time. We take any related discount or premium associated with those bonds off the books at that time of conversion, right? We issue the common stock at par, and then the balancing entry is going to be to the additional paid-in capital, which choices A, B, and C we're looking for here. Now, when you take a look at this, if we're going to issue the common stock at par, then the market price of the common stock is a distractor. To get rid of that. And when we take the bonds off the books, we take them off at their book value. So the market price of the bonds is a distractor, is irrelevant to being able to answer this question. Okay? So now we've sort of narrowed it down to the three choices, and we're going to have to tease out the information that we will need to answer this question. Now, I've got to admit to you guys that this question, and I don't always see this when I first select a question, it's not until I work with it a little more closely, getting ready to talk to you about it, that I realize, okay, I'm not exactly in love with this question, because they tell me that the total issue was $4 million. They tell me that the total unamortized premium associated with this issue at the time of conversion was this $280,000. So they give me the total issue, the total premium associated with the entire issue, but the entire unamortized premium associated with the total issue. But I have to then figure out, well, how much of the total conversion relates to that premium. So I have to make this annoying calculation where I have to say, well, look, if the total issue is $4 million and we're converting what? We're only converting 1,280,000 of these bonds, then we really are only converting what? And it comes out to 0.32 or 32% of the bonds. If that's the case, then they're giving me the entire unamortized premium, but only 32% of that entire amortized premium is actually being associated with bonds that are actually being converted. So I've got to take that 0.32 times the 280,000, and that gives me 89,600. That's the amount of premium that I'm going to be taking off the books. But a premium is a credit, and when you're taking premium off the books, you have to do what? You have to debit it. So C is the wrong answer. Okay, so again, what I'm going to do is I'm going to have to take the bonds off the books, related premium off the books, and then issue the common stock at par, and then the answer to this question is going to be the amount that is getting credited to APIC. So pretty quickly, I'm narrowing this down to one or two choices, right? Okay, so if that's the case, then I'm going to go ahead and I'm going to debit bond payable, we're abbreviating that BP, and I'm going to take those off at face. Those are the bonds they're telling me here we're getting converted. I have to what? I have to debit the premium, because a premium was a credit when it was set up, and since I'm taking those bonds off the books, I have to take off the associated premium, which was that annoying calculation where I had to figure out how much of the total. I would probably give you questions where I would actually tell you the amount of premium or discount that was associated with the bonds that are being converted, rather than make you kind of read through this poorly written sort of labyrinth of information that made this more difficult than it needed to be. Then what? Now I have to figure out, well, how many bonds are being converted. And so what happens, they're sitting here and they're telling me that the face on these bonds is 1,280,000. They're telling me that each bond has $1,000 face. So that means that we are actually doing what? Converting 1,280 bonds. 1,280 bonds, and they tell me that each bond has what? Has 30 shares that will be issued. So it's times 30 shares, and again, I issue those at par. So 30 shares times $30 times 1,280 bonds that are being converted, that gives me a total here of, let's just recalculate the total, okay, because I calculated it, but there it is. I found it. Okay, don't panic, John. It's what? It's 1,152,000. So that's issuing the common stock at par, 1,152,000. And then, of course, a journal entry has to balance. And so the difference is what? The difference between the book value of the bonds that you took off, right? The face plus the premium up there, and the common stock, that difference is going to be the credit to APIC here, which is this 217,600, which is the answer right here, choice A. Okay. All right. I don't think I would give you something that has this weirdness in here. Okay. I think even though there's another question, I think that did this same thing. I would tell you the amount of discount or premium, and then you would go from there to be able to figure out the amount that needed to go to. Probably the APIC is the most interesting part of the journal entry that I would expect you to want to be able to figure out. Notice again, guys, the way I do these questions, I make the whole journal entry. I don't sit there and try to think about a piece of a journal entry. I sit there and think myself all the way through so that I'm very confident in what I'm selecting to be the correct journal entry, the correct part of the journal entry that's being asked in the question. Okay, good. Let's take a look at number 2 here now. We say on July 1st, 2021, an interest payment date. 150,000 of Park Company bonds were converted into 3,000 shares of Park Company common stock, each having a par value of 45,000 and a market value of 45,000. Thank you very much. I know I'm going to ignore that. I don't use the market value in these calculations. There is a 6,000 unamortized discount on the bonds. See how much gentler and kinder that is? Where they just tell me the discount, tell me the premium. That's more what I'm going to be giving you. They tell me to use the book value method. As I mentioned in the lecture, there is something out there called the market value method. GAAP only recognizes the book value method, so we're just going to study the book value method. Okay, and so Parks would record. And again, we have to figure out if there's some impact. In this one, I can't really write out, eliminate anything, because they are asking me for the journal entry to additional paid-in capital. And I'm pretty sure that's going to be affected here when we look at this question. Okay, but what happens? What do you do? Well, since you're getting rid of the bonds, 150,000 are being converted, I'm going to go ahead and I'm going to debit bond payable 150,000. I know I have to do that. I know that if I'm getting rid of the bonds, I have to get rid of the discount associated with those. And when I issued the bonds, if I issue them for less than face, remember I debit discount. If I'm trying to take a discount off the books now, I'm going to go ahead and credit the discount for 6,000. Okay, I think I said in the lecture that most times these convertible bonds issue it more than face, but it could issue for less than face, and so that's what we went ahead and did here, right? Okay, good. Now we have to issue the common stock, and we know that we credit the common stock, and we have to issue it at par. $45 per share is the book value, or the par value for these shares, and how many shares? Good. I may make you figure out the number of shares by, sitting there and figuring out, well, how many shares of stock per bond. I may make you do that, or I could give you a little easier situation here, like we did here, where they just came right out and told you the number of shares, which was 3,000. So you take that 45 times the 3,000 on this one. And again, I calculate these numbers and then I don't write it down, but I think that's 135,000. So I'm going to go ahead and I'm going to credit the common stock for 135,000 because I have to issue that at par. And to make this journal entry balance now, I'm going to have to do what? Credit the APIC, and I'm going to credit the APIC this 9,000. Okay, and so B is the correct answer there. All right. Okay, good. Let's go ahead and let's take a look at this next one. And they tell me that Morgan had 2 issues of securities outstanding. common stock and an 8% convertible bond issue in the face amount of 16 million. Now, when I look at this, it makes me feel like, well, I'm going to have to deal with both of these, and then you get down to it, they're going to just end up converting one of them, not both of them. I think it's the bond that they convert, so I don't have to deal with two conversions on this question. Anyway, interest payment of the bond issues are June 30th and December 31st. The conversion clause in the bond, indenture entities, the conversion clause in the bond indenture entitles the bondholder to receive 40 shares of $20 par value common stock in exchange for each $1,000 bond. On June 30th, 2021, the holders of 2,400,000 face value bonds exercise the conversion privilege. The market price of the bonds at that time was, I don't care. Okay, we're going to use what? We're going to use the book value. I don't care what the market price of the common stock was, because I would use the par value in this calculation. Okay, so I go ahead now and I have the par value up here. Okay, so I've got that. So now I need to go ahead and I need to figure out, okay, how many bonds are they going to take off the books at this point in time? And they tell me, they just give me that number. It's 2,400,000 is the face of the bonds that were exercised. So let's just go ahead, and even though they're asking me for the paid in capital, and notice they're not asking me about the preferred stock here, so I could ignore that fact that they had these two issues. It is simply the bond that's being redeemed. So I go ahead and I debit the bond payable, the full 2,400,000. Okay, now I need to sit here and I need to figure out the number of bonds that are associated with this. So 2,400,000 bonds. It's what, $1,000 each bond. So when I go ahead and divide that by the $1,000 each bond, that now goes and tells me that there are what, 2,400 bonds. Right, that's 2,400 bonds we're dealing with here. And then I need to figure out the shares, and they tell me how many shares per bond, and the answer is what? 40 shares. So if it's 2,400 bonds and I can get 40 shares for each bond, that means that it's what? 2,400 times the 40 shares. 2,400 times 40 is 96,000 shares. Right, 96,000 shares. 96,000 shares times the market, or the par value is $20 per share. So that gives me $1,920,000. I know I have to credit that to the common stock. Okay, so that's that 1,920,000. And then what was the situation here with the premium or discount, was it? Okay, so I go ahead and they tell me that the total unamortized premium is $1 million. Here we go again. We've got to deal with that annoyance. If they're telling me that it's $1 million total premium for all the bonds, I have to figure out how much, not premium, but discount. I have to figure out how much of that discount now is attributable to these bonds that are being redeemed. So if that's the case, it's 2,400,000 that are being redeemed of the total issue of 16 million. I won't do this to you on your exam, guys. I don't care for this kind of a bothersome calculation. That gives me what? That gives me 15% or 0.51 that's being redeemed. The discount is $1 million times 0.15 gives me what, 150,000 of discount that needs to be removed from the books for these bonds that are being redeemed, right? These 2,400,000 worth of bonds that are being redeemed. Discount is a debit when you acquire the bond, so I'm going to credit the discount to take it off the books, right? As I'm retiring those 150,000, and then I can go ahead and finish my journal entry, which is the answer to this question. You would have to credit APIC, therefore, for $330,000. Okay, so I would say be ready for something more like this question, where I'm not gonna, have you kind of doing this maneuver over here to figure out the portion of the discount that needs to be taken off the books or something, okay? But I could make you figure out the number of shares. I probably will do that, okay? Okay, good. Let's take a look here at number 4, see what we've got here. So we've got this Chang Corporation issued 600,000 of 9% 10-year convertible bonds on July 1st, 2020 at 96.1, okay? This drove me nuts because I missed that 0.1 and I was losing my mind trying to figure out why I was a little bit off until I looked more carefully at the question and saw that 0.1 in there. Again, I'm not going to put a 0.1 in a question for you to it's easy to miss that, okay? The bonds were dated July 1st, 2020 with interest payable April 1st and October 1st. Bond discount is amortized semi-annually on a straight line basis. On April 1st, 2021, 1,200,000 of these bonds were converted into 500 shares of $20 par value common stock. Accrued interest was paid in cash at the time of the conversion. If interest payable were credited when the bonds were issued, what amount is the debit to interest expense? Well, first of all, it doesn't matter that they credit the interest payable, whatever. We have to figure out the interest expense. And the interest expense on a discount bond is what? This is really a chapter, whatever it was, chapter 14 question. What is the interest expense on a discount bond? It's the cash interest plus the amount of premium amortization, okay? So how am I going to figure out the amount of premium amortization that happens here? Well, if you look at this, they issued the bonds, had a face of $6 million. And they issued the bonds at this ridiculous 96.1. You have to multiply that by, instead of 0.96, like I did when I first worked the question and then started losing my mind as to why I'm having so much trouble finding the answer, it was 0.961. Okay, now when you do that, that means that these bonds issued for $5,766,000. Let me double check the math on that. 0.961 times 6 million. All right, 5,766,000. Okay, good. So that's the amount of cash they got on the issue. If the face was 5 million, 6 million, and the issue price was 5,666,000, that means that these bonds ended up with a discount of I'm seeing 234,000. That's the discount. Okay, now what happens? We have to amortize that discount. And that discount is going to be amortized over how many months? Well, they tell me it's a 10-year bond. 10-year bond. If it's a 10-year bond, 10 times 12 is 120 months. But they didn't issue the bonds until July. The bonds are dated what? April 1st. So that means of that full 10 years, 420 months, there was what? They weren't issued April, May, June. So the real period that they're amortizing them over is not 120, but what? But 117 months is what they should be being amortized over. So now you take that 234,000, you divide that by 117. That means that these bonds per month will amortize that discount at $2,000 per month, right? Okay. Now what happened? The bonds sat there, okay, and they were issued on July 1st, okay, and they tell us that the bonds got what? The bond discount is amortized semi-annually on a straight line basis. On April 1st, 2021, 1.2 million of these bonds were converted into $500 cash. So if that's the case, on April 1st, 2021, that means that those bonds sat there and had what? Had amortization for 3 months. So you go ahead and you take that 2,000 times what? Times the 3 months of amortization. 2,000 times the 3 months gives me $6,000 of amortized premium that would amortize for that 3 months when what was credited to bond interest expense on October 1st, 2020. Okay, so again, the 3 months is going to be what? July, August, September, right? That's the interest for, let me just go ahead and July, August, September here on this question. That's the 3 months that had amortized off that premium from the date when they were issued, July 1st, July, August, September. So that's 6,000. And then I just have to sit here and say, well, okay, I've got that. What's the cash interest on these? Okay, and if it's a $6 million bond times 0.09, that means that the cash, the pure cash interest, right, is going to be 6 million times 0.09 is going to be oh, and then it's semi-annual. So if you do it times 1/2, okay, 6 million 0.09 is going to be 270,000. But this is only for what? For 3 months worth of interest. So this is only going to be what? This is going to be July, August, September, the 3 months. So it's 3 months worth of interest. So if we go ahead and take that 270 and divide that by, and I guess I could have done this a little smarter instead of doing this by 1/2. 3 months is actually what? 3/12. Okay, if I get the total annual interest, let me do this a little differently. I'll just multiply that by 3/12. So now I get the 6 million times what? Times 0.09 times 3 divided by 12 gives me 135,000 of interest expense for those 3 months. Now that I'm having to pay the interest out July, August, September, because those bonds were only outstanding for that 3 months, plus the 6,000 of amortization of premium. That gives me now of discount, excuse me. I add the discount amortization. That gives me now 141,000 of interest expense, the correct answer here. Okay. Now they tell us that they had, when they issued the bonds, they also got any accrued interest on those. So they would have collected the $135,000 of interest that would have accrued for the first 3 months that these bonds are that these bonds from the date they were dated, April, May, June, those 3 months, then the whole journal entry here would have been to pay back that interest, would have been to debit interest payable. That's going to be my April, May, June. Okay, so the interest payable is going to be debited for $135,000. Interest expense, we just calculated interest expense. Here we go, guys. I'm going to have to write on top of writing here. Was $141,000. There's that debit. Where do I want to write this journal entry? Oh, okay, thank God there's some room down here. Okay, I'll just write it here. So interest payable, okay, $135,000. Interest expense, right? We just calculated $141,000. Okay, we have to do we have to go ahead and amortize the discount. The $6,000, and then we go ahead and we can credit the cash for the full 6-month interest payment, which is what, $270,000, right? That $270,000, of course, makes a journal entry balance, but it is also the 6 million times what? Times the 9%. Was that what it was on these bonds? Times 1/2, right? Okay, so we pay $135 for a 3-month period. For the full 6-month period, you'd kick out $270,000 cash. But when you issue the bond in between interest payment dates, some of that is simply return of the cash that you had recovered from them at the time that you issued the bond. Okay. All right. Good. That question really could have just as well been in, chapter, whatever it was, chapter 14, when we talked about bonds. Okay. Okay, so let's go ahead and let's take a look at this next question. And it has pretty much the same facts. It's the same bond issue as the previous question, same company here. So this question, remember that it issued for a total discount of $234,000, that 96.1. And so when you look at the total discount, okay, of $234,000, they want to know of that $234,000, how much is the unamortized discount at what, April 1st, 2021. Now that's 9 months after the issue, right? We issued them on July 1st. We're going all the way to April 1st of 2020. July 1st, 2020. We're going all the way to April 1st of 2021. That's going to be 9 months. And they want to know how much of the discount is unamortized, but they want to know how much of the interest is unamortized for what? For the 1.2 million of bonds that are being converted into stock at this point. Okay, so what am I going to do? Well, let's first do that annoying if it's 1,200,000 and the total issue is what? 6 million. Okay. By my calculation, that means that they're actually only converting 0.2. So only 0.2 of the total unamortized discount at that date is attributable to the conversion. Okay, so I get that out of the way. Then I have to sit there and say, well, what's the unamortized discount? Well, if the unamortized discount, if the discount amortizes, and it's what we figured that out before, it was the 234 divided by 117, it's $2,000 a month, and these bonds have now been outstanding for the 9 months. You take the 2,000 times the 9 months, 2,000 times the 9 months, the 3 months, the 6 months in 2020, and now the 3 months in 2021, right? January, February, March, don't count April because it was April 1st, means that they have amortized off of here now $18,000. 234,000 minus 18,000. 234,000 minus the 18,000, all right, means that there is what, 216,000 of unamortized discount, of which only 20% of that was attributable to the conversion. So 0.2 gives me the correct answer here, 43,200. Okay, so I don't know, the book was in love with this whole little manipulation. I don't find that particularly interesting, so I don't think I'll make you do that. But I could be asking you the various parts, and I think you're kind of seeing the theme here, various parts of the journal entry of the conversion of a convertible bond to stock, and whatever amount of unamortized discount or premium comes off the books. The bond payable part of it is the easiest part because it's simply whatever the face of the bonds were, and then issue the common stock at par, and then to balance the journal entry becomes the APIC. Okay, that was sort of the theme with a lot of those questions. All right, good. Now we come over, and when we look at this number 6 here, looks like we're going to be dealing with some more bonds. Okay, I thought we were going to jump into a question where you might see some conversion of the preferred stock, but I guess we're going to have to wait for one more question on that. Okay, so let's look at this one again. It's bonds, and the corporation issued a premium of 10,000. Of 10,000, issued at a premium of 10,000. They're not getting any Pulitzer prizes for the way they're writing these. A $200,000 bond issue convertible into 4,000 shares of common stock at par value. Now look, that I know that's gold. I know that they're asking me what? They're asking me they paid in capital excess at par, so I know I'm going to have to pick up the par value of the common stock, right? At the time of conversion, the unamortized premium is 4,000. The market value of the bonds is 220. I don't care. They love to give you that. The stock is quoted on the market at $60 per share. I don't care. If the bonds are converted into common, what is the amount of paid in capital in excess of par? So thank you, God. This question wasn't nearly as difficult because I know that they're doing what? They're sitting here and they're going to get rid of the entire issue here. So it wasn't a piece of the issue, it was the whole thing. And they tell me that the unamortized premium, okay, this question was a little bit, the time of conversion was 4,000, so I know I have to take the premium off the book. Since it was a credit when I issued the bond, it is now going to be a debit to take it off the books. Okay, a little nicer question. This might be more how I'll ask you this, although I may make you calculate the number of bonds and therefore the number of shares rather than what they did here, which is they give me the number of shares, right? They tell me it's converted into 4,000 shares of common stock. So I take the 4,000, I'll put that over here. I picked up that par value times the $20. What's that? I hope that was easy as it looks, 80,000. Credit the common stock at 80,000. Credit the APIC to make the journal entry balance, of course, which is going to be 124,000. Okay. All right, good. So that question was a little more straightforward. I'm not in love with all this jazz here. I think the main thing, you don't have to attribute it to some part of it. I think the main thing I'm going to make you do is the hardest part, or the part that's maybe a little harder than this question anyway, is I may make you calculate the number of shares. Okay. Okay, good. number 7. And thank you. This one now is going to ask me again. The additional paid-in capital account seems to be the one that's picked on, because you got to kind of figure everything else out to get that one, is the reward for figuring all the rest of it out. But now we're dealing with preferred stock. Again, no gains or losses. I didn't think it asked me for a gain or loss, but there's no gains or losses on this. You're going to do what? You're going to take the preferred stock off the books at par, remove what? Any associated paid-in capital in excess of par associated with that preferred stock, issue the common stock at par. APIC is the resulting answer for this. Okay, so they tell me that we issued for $103 per share 90,000 shares of the $100 par value convertible preferred stock. Okay, thank you. So I do need that because I'm going to have to take the common stock off at par when they do the conversion, and I'm going to have to take off the APIC associated with that preferred stock. Let me say that again. I have to take the preferred stock off the books at par, and I have to take any additional paid-in capital associated with that. So I do need to know what they issued it for versus the par value. 1 share preferred stock can be converted into 3 shares of, and I kind of put a line through that, not wanting to, okay, $25 par value common stock at the option of the preferred shareholders. In August 2021, all of the preferred stock was converted into common stock. Again, market value is not relevant to this. You issue the common stock at par, and they want to know the APIC. So if that's the case, what am I going to do? I'm going to take the 90,000 times, 90,000 shares, times the $100 per share. So that means that preferred stock, PS, has to be debited for 900,000. Okay, good. Then what? Then I need to take those 90,000 shares, I'll write that over here, times the $3 above par that they were issued. That's 270,000. And that's going to come out of my APIC. PS is not, I'm not writing a letter here. PS is the amount that's for the preferred stock. And I'm just going to line my numbers up a little better here. Okay, those are both debits. Right? Okay, then I issue the common stock at par, but I got to figure out, well, how many shares of preferred stock are we going to be dealing with here? And so I have to see that it was 90,000 shares. And how many shares? 3. So if it's 90,000 shares of preferred stock, but I get back, I have to issue 3 shares of common stock, that's 270,000 shares. 270,000 shares times what? Times the $25 par value. 270,000 times 25 gives me 6,750,000. Right? And so I'm going to go ahead and issue the common stock at par, 6,750,000. And again, the last part of these journal entries is always the APIC to make the journal entry balance. The APIC now needs to be credited, and again, this is APIC common stock. I'll put CS down here for common stock. That needs to be credited 2,520,000. Is that the answer? Good. Okay. Okay, good. Let's go ahead. I'm going to let you take a quick break, and we're going to be back in a second. So if you don't want to hit pause, you don't have to. It'll come right back. Otherwise, you might want to take a little break here. Okay, good. So let's go ahead and let's take a look at this next question. And now we're going to be dealing with how we handle stock warrants. And remember, we said that the stock warrants, if they are detachable, which these are, okay, then they are seen as a separate instrument. And so we're going to have to take the amount of cash that comes in on this issuance of a bond with a detachable stock purchase warrants. And it's going to be our job here to figure out, well, how much goes to the warrants and how much goes to the bonds. And again, remember we said we will always use the proportional method to figure that out, okay, in this class anyway. And I think in most, even in practice, that's probably the case. So we take a look at this problem and they tell us that we have these $2 million convertible bonds and they issue them at 104. Okay, great. So now what happens? Well, it's 2 million, and sorry, not convertible. They're non-convertible, but they have what? They have the detachable warrants. So we have to figure out how much of the total issue price should go to the bonds, should go to the warrants. Okay, so that's 2 million times 1.04. They told us they issued it at 104. And I do the math on that, and I think I get this $2,080,000 that's come in on this. Okay, so I go ahead and that's my cash, the 2,000,000, right? 80,000, and my job is going to be how much goes to the bonds, how much goes to the warrants. And of course, the answer to this question is the warrants part. But let's see how to figure out how to allocate that cash using the proportionate method. Okay. Now we look, and they tell us that the bonds without the warrants would sell at 95. Well, if that's the case, then if you were to take that 2 million, right, face on those bonds up there, okay, and you multiply that by what? 0.95, okay, that means that the relative market value associated with the bonds, okay, is going to be the 2 million face times 0.95. That's $1,900,000. Okay, good. Okay, now I got to figure out, well, what's the value of the warrants. Okay, and they come over here and they tell me that the warrants would normally, the bonds without the warrants would sell at 95. On March 1st, 2021, the fair value of the common stock was 40, I don't care, per share. And fair value of the warrants, thank you, is $2 per warrant. Okay, so so now I have to look, and I have to say the fair value of the warrants was $2. They probably should have been a little more careful to say per warrant. But I have to figure out, well, how many bonds do I have? And then how many warrants do I have? So if it's a $2 million face on the issue, and each bond is what? $1,000 bond, 2 million divided by $1,000 face of each bond equals what? Equals where's my calculation? Okay, so it's 2 million divided by the 1,000 gives me 2,000 bonds. And then they tell me that what? Each bond has how many warrants? Was issued with 25 warrants. So if I take the 2,000 times the 25 warrants per bond, 2,000 times what? Times 25 is going to give me 50,000 warrants. And then they tell me that the market value of each warrant was what? Was $2. 50,000 times $2 means that the value at market value anyway of those warrants is 100,000. Okay, so the bonds, I'm sure we know what we're calculating here. The bonds were 1.9. The warrants are 100,000. that gives me what? That gives me total value here of 2 million. Okay, so now to figure out, well, how much of this money here, 2,080,000, right, of the cash, should go to the warrants, I'm going to take 100,000, that was the amount for the warrants, divided by the, what, 2 million, which is the value of the bonds and the warrants, 100,000, okay, divided by the 2 million, gives me 5%, 0.05, 0.05 times 2,080,000 gives me 104,000. Okay, so of that total cash that I got, 104,000, I'm going to write it over here as well, are going to go to the warrants. The bonds are going to be what? And the way I would calculate that for the bonds, and I think you can see where this is going, 1,900,000 divided by 2 million gives me 0.95. 0.95 times, again, that same 2,080,000 now is telling me that for the bonds, the total amount, just go ahead and calculate it, 0.95 times 2,080,000 says 1,976,000 is attributable to the bonds. Now look, guys, I'm going way beyond what was necessary for this question, because at this point I could have answered the question, the amount that is APIC warrants, but I'm going a little further because I'm just going to show you the whole journal entry. So when I go ahead and I issue these bonds now, I'm going to debit cash for the full amount of cash that came in, 2,080,000. Okay, I always go ahead and credit my bond payable, and I credit my bond payable at par. Bond payable at par is 2 million. Always going to do that. Okay, then what? Then I go ahead and I have to credit APIC, and I'm going to put a W in there for APIC warrants, 104,000, which I just calculated up there. And now I have to do what? Well, if I put 1,976,000 of the total issue price to the bonds, and the bonds have a face of 2 million, that means that I have to debit the discount 24,000. Okay, that's it. Okay, so that would be the entire journal entry. This was just asking about the warrants part of it. Okay, all right, good. Let's go ahead then and let's take a look at the next question, and we're going to start to get into some earnings per share calculations here. So now the question is, how do I calculate my earnings per share for common shareholder, the basic earnings per share, primary earnings per share, and then how do I calculate dilutive earnings per share for the potential dilution of conversion of bonds to stock, preferred stock to common stock, basically are the two conversion things that we're going to look at. And we use the if converted method in some cases. In other cases, and if we had warrants outstanding, we use the if converted method to see what would happen. We always have to keep in the back of our mind, guys, do not include in a diluted calculation any security that is anti-dilutive, that increases the earnings per share above the basic. So you will always have to calculate each instrument separately to make sure that none of them have an anti-dilutive element, because you only include those with dilutive elements, those that have the ability to decrease the earnings per share. Okay? All right, good. So with that quick little review, let's go ahead and let's take a look at this one. And this one's kind of an easy one, I guess. If any of this stuff is easy, like I said in the lecture, I understand this is all very rules-based stuff, and so it kind of gets hard to wrap your head around everything that we're doing. And so you're kind of seeing that here, so it's going to be important that you kind of get these sort of little details. You practice with these questions here to get yourself comfortable with these little details. But this one doesn't have quite the nuance as some of the others, because they tell me that they want the common per share. Okay, now in this case, we have what? We have preferred stock, and remember, we're going to have to take our net income and subtract out any dividends that are attributable to the preferred stock. Okay, so what happens? We sit here and we have the net income, and the net income, they tell me here, is $960,000. Okay, so I pick up that 960. I know I need that. But to get the common, I have to subtract out any preferred dividends. So I come over and they tell me that there are 10,000 shares of 6% $100 par value cumulative preferred stock outstanding. No dividends were declared. Doesn't matter. They don't have to be declared. They have to be declared in order for the entity to have to show a dividend payable liability. But to calculate our basic common earnings per share, we go ahead and subtract out the dividend, even if it's not declared. So if that's the case, if it's what, 10,000 shares, it's what, $100 per share. It's 6%. And I go ahead and I make that calculation. And again, as usual, guys, I apologize that you got to sit here and watch me do this. I do the calculation, I see the number on my calculator, and then I forget to write it down. So that's a million times 0.06. That's going to give me 60,000. That would be the preferred dividend, okay, even though they didn't declare it. To calculate my common earnings per share, I subtract it anyway. That gives me 900,000. And then I need to go ahead and divide it by the shares that are outstanding for the period. Now, this is a little bit interesting. They have 200,000 shares of common stock, and then they say prior to the issuance of the financial statements for the year ended December 31st, 2021, Pine declared 100% stock dividend. If that's the case, I go ahead and assume that that conversion, I'm going to report that earnings per share as though that conversion happened in 2020, because it happened before I was issued my financial statements. Okay, so or I shouldn't say 2020, but that it occurred in 2021 before I issued my financial statements. I issued my financial statements in 2022. But since the stock dividend was declared before I issued the statements, I go ahead and I include those shares. And so it's 200,000. And if it's 100% stock dividend, that brings this to what? I'm just going to write it this way: 200,000 plus another 200,000, 100% stock dividend. So I'm going to divide that by what? 400,000. That gives me the correct answer here, which is $2.25 per share, right? Okay. Okay, good. That's that one. Let's take a look at number 10 now. And number 10, now we are going to see that we have a convertible bond. And when we have a convertible, my bad, I was looking at 11. That's 11. Let's look at 10. And with 10 now, they just want to know the shares that you should use for calculating the diluted earnings per share. So notice here, guys, there is no discussion of dollar amounts. There's no dollar signs. They want to know the number of shares. Okay. So they tell me that they had 1 million shares of stock issued and outstanding at December 31st, 2021. And notice that they want to know what should be used for 2021. So if it's December 31st, 2020, not 2021, 2021, that means what? For 2021, I had a beginning balance in here, I'll even call it beginning, of 1 million. That's 1 million shares. Okay. Okay, good. Then they come over and they tell me on July 1st, they issued an additional 1 million shares. Well, okay, great. That's an additional 1 million shares. But since they didn't issue those until what? Until July 1st, then really those additional shares were only outstanding for 6/12, right, of the year. So that should be 500,000 on a weighted average basis. That gives me the 500,000. And then they come down and they tell me that we're issued for cash. Stein also had stock options outstanding at the beginning and end of the year, which allow holders to purchase 300,000 shares of common stock at $28 per share. The average market price of Stein's common stock was $35. So since I'm trying to sit here and calculate the number of shares that would be outstanding for diluted, I have to, and remember I said this is where you get to use your imagination, pretend like those shares were actually converted. So if it's 300,000 shares of common stock and they can be converted when the holder of those options give me $28, I would take the 300,000 times the $28 that are going to be paid in when they exercise those options. And when I do that, I'm going to get $8,400,000. Now, the Treasury Method says, well, if that's the case, if you got $8,400,000, and we're going to assume, because they didn't really convert these, right? So we're in pretend land now. If you got $8,400,000, we're going to pretend like you took that $8,400,000 and you went in the open market and bought all the shares you could. Well, if you're sitting there and the market price of the stock is $35, then you take that $8,400,000, you divide it by the $35 per share. That means that you could have acquired 240,000 more shares, right? But the conversion was what? The conversion was 300,000 shares, right? That's what the problem told me. So that means I couldn't buy back what? I could buy back all but 60,000 shares. So that needs to go into my shares outstanding for the period to calculate my diluted earnings per share. That gives me now the correct answer when I add that all up, 1,560,000. Okay, isn't this fun? You get to use your imagination a little bit with some of these things because they really never converted these. It's just if you did convert them, what would have happened? Okay, all right, good. So you come over and again, we've got a diluted earnings per share calculation. Okay, and what's going on here now is they want me to go ahead and pretend that these options got converted, right? So I have net income of 600,000. They give me that, okay? And then they tell me that the average number of shares outstanding were 200,000. They give me that. I didn't have to calculate it like I did up here. It was 200,000, and now I have to see what happens if you pretend that these options got exercised. So the option price is $30 per share for 12,000 shares. So that means that if the options, I get to pretend, if the options had been exercised, it would have been 30 times 12,000 30 times 12,000 is going to be 360,000, John. Okay, 360,000, and then what? I could have bought back, okay, if the market price is $36 per share, I could have bought back 10,000 shares using that money. Well, if I had 12,000 that got exercised, and I can only buy back 10, that means that there's going to be an extra 2,000 shares floating around out there. So I go ahead. Again, none of this conversion took place, so 200,000 plus the 200,000 divided into 600,000 gives me this 297. Okay, isn't this fun? You actually get to pretend a little bit in accounting sometimes, and so that's kind of nice that we're getting to do that here. Okay, we just have to remember to pretend the way they've told us to pretend. Okay, all right, don't go too crazy with this stuff. All right, good. Let's go ahead and let's take a look at this one. And now we've got what? We've got convertible bonds. Okay, and they tell us that each $1,000 bond is convertible into 10 shares of common stock. No bonds were converted, and the company had 200,000 shares of common stock outstanding in 2021. Their net income is 900,000. They give me the tax rate here, and now the tax rate is going to be important because I have to figure out, if I convert the bonds to stock, what is the interest savings, but I have to consider the tax effect of that interest savings, so I have to take that interest savings net of tax, and of course they want the diluted, so I'm going to go ahead and I'm going to do a couple of things here. Now the first thing I'm going to do, okay, and this isn't something that leaps to mind because you want to hurry up and figure out the diluted. Be careful. Make sure that you know what the basic earnings per share is. So I'm going to pick up that 900,000. I'm going to go ahead and I'm going to divide it by, they told me the shares outstanding were what? 200,000 shares. So that's going to give me what? $4.50 per share. That's the basic. I'll even go ahead and write basic there, okay? I have to put that over to the side because, again, I will not report the diluted if it is what? I will not report the effect of the potentially dilutive shares if they're anti-dilutive, right? So I have to see that, okay? So right now, I'm thinking, well, maybe the answer is C. I got to see what happens when I go ahead and use the if converted method here. So what happens? Well, if the bonds were $2 million bonds, and if I have 5% stock, 5% bond, right? Okay, that means that I would have had interest there of what, 100,000? But remember, I have to figure that out net of tax. So I'd have to take 1 minus the tax rate, or 0.7. So I'd have an interest savings net of tax of 70,000. So now I take the 900,000. I add 70,000 to it. That gives me 970,000, right? That I would have had of net income if I had gotten rid of those bonds. But of course, now I have to do what? Now I have to figure out, well, how many more bonds how many more shares of stock would I have if I would have converted the bonds to stock? So it's $2 million is the face. It's what? Each $1,000 bond means that out there were 2,000 bonds. Each bond carries with it what? 10 shares. So I multiply that by the 10 shares. 2,000 times the 10 shares gives me what? Another 20,000 shares. So now my denominator here would be the 200,000 shares plus these additional 20,000 shares. That would make that 220,000. 970,000 divided by 220,000 gives me 4.409, whatever, or what, 441, the correct answer to this question. I report it because it is dilutive. Okay, if it was anti-dilutive, then the correct answer here is what? Is, well, the answer would be don't report, none of the above, whatever. Don't report a diluted earnings per share if it's anti-dilutive anyway, okay? Okay, good. Let's go ahead and let's take a look at the next one here. Okay, let's go ahead and take a look at this next one now, number 13. And they start telling me about the common and preferred stock. They've got some convertible bonds going on here. And they want the basic earnings per share. Okay, so it's a little more straightforward. If it's the basic earnings per share, I do what? I take the net income, which they tell me here is, where's my net income? 600,000. Okay, now sometimes students get confused because they see that 600,000 net income and then they see the tax rate and they want to try to figure out the net income net of tax. No, net income reported by GAAP is after you've already subtracted the tax. Tax is an expense, right? Even though it's shown in its own section on the income statement, you don't subtract the tax, take 70% of, say, the 600,000, because if they're calling it net income, the tax already been subtracted. Okay, so I've got the 600,000, and then I need to do what? I need to subtract the preferred dividends. Spell preferred dividend. Okay, preferred dividend. I think I put an extra F in there, but whatever. Preferred dividend, 2 R's, 1 F, John. Okay, the preferred dividend. Let me write that better. Okay, the preferred dividend is going to be subtracted from that. Okay, the preferred dividend. So what is the preferred dividend? Well, they tell me that in this particular case, this preferred stock is what? There are 20,000 shares of preferred stock. Okay, and what? And they paid $3 per share on the preferred. So that's a pretty easy calculation. 20,000 times the $3 per share means the preferred dividends were $60,000. So we have what? 600,000 minus the $60,000 preferred dividend, okay, means that I have $540,000 of net income available to my common shareholders, okay? And so if I take that $540,000 that's available to my common shareholders and I divide that by the number of common shares, right? Earnings per common shareholder gives me this 270 down here. Okay, now what's going to be interesting here for this particular set of facts is the same set of facts are going to come in now here, but now they're going to ask me for the diluted. Okay, same fact pattern, now diluted. Now the reason I'm pointing out the importance that it's the same fact pattern. I don't want that 250. Okay, I just want the 270 to be highlighted. Is it going to let me do that? I'm trying to just highlight the 270, okay? The 270, because when I calculate the potential dilution of these other, the convertible bond and the preferred stock, I always have to check it back against the basics for each item to make sure that it doesn't increase above the 270. If it does, then I'm going to throw it out and my diluted is just going to only consider dilutive instruments, right? Okay, so let's just go ahead and let's see how that's going to work, but I'm going to kind of write that number down, that 270 there. And if you didn't have a problem that made you calculate it, then you'd have to calculate it anyway because it's necessary to see whether or not you have anything that's anti-dilutive. So let's first deal with the preferred stock. Okay, that one's easier, a little easier. They're both easy, but this one's a little easier. Preferred stock conversion. So what happens? Well, if that's the case, then I just take the 600,000 net income. Again, it's the same fact pattern, but we've got this convertible preferred stock. Okay, so it's 600,000, and they tell me that the preferred stock is convertible into 40,000 shares of common stock. Okay, so I would get rid of the preferred dividend, but now I've got more shares of common stock, and so it's the 200,000 plus these extra 40,000 shares. So when you do the math on that, 600,000 divided by 240,000, you get 250 per share. Now that was dilutive because when I compared it to the basic, I got a lower number. So I'm going to include this one in the calculation. Now let me see what happens with this convertible bond. Okay, so I'm going to, and I'm going to write it up here, guys. I know I've got that 600,000 of income, but now I have to add what? The interest savings, because if I convert the bonds to stock, I don't have that interest anymore. So if it was what, 1,500,000, 5% bonds, right? I'm going to take the 1,500,000. I'm going to multiply that by 0.05. Okay, 1,500,000 times 0.05 means I would have had $75,000 interest, right? $75,000 interest, but the tax rate is 30%. So net of tax, 0.7. That's going to come out to $52,500. I add that back to my net income because I have that interest savings net of tax. So now that's going to give me this $652,500. But now I have to divide that by the total shares. Okay, now I know there's 200,000 shares, but I have to add the number of shares that would have gotten converted into the stock. So I sit here and I say, well, look, they tell me that it was 1,500,000 was the issue. Again, I think you're getting used to this. 1,000 bonds, $1,000, I should say, per bond, right? Each $1,000 bond. That means that there were 1,500 bonds here. But then when I look at the problem, 1,500 bonds, but they're convertible into 30 shares of stock. So 1,500 times 30 means that I would have an additional 45,000 shares outstanding. So I have to add that to the denominator now. Okay, so I added the income back, but now I take that 652,500, divide that by what? 245,000. And when I do that calculation, I come up with 266 per share. So earnings per share. So now I'm like, okay, both of these are dilutive. So now I got to what? I got to put them together. Okay, so now I sit here and I say, okay, well, my income would have been 652,000, right? My net income, because I don't have to worry about the preferred dividend plus the interest savings. Number of shares now are going to be what? The 200 plus the 40 plus these what? 45,000 additional shares. That comes to 285,000. And when I do the math on that now, I get this 229 per share, and the 229 per share is the correct answer. Okay. All right, that's kind of a lot, but that's sort of the process you have to go through. Calculate each dilution separately. Anything that is anti-dilutive brings the earnings per share up above the average, the basic earnings per share, throw it out and only consider dilutive ones. Those were both dilutive, so I didn't have to throw anything out. Guys, these next two questions, I don't want to go through these. I thought they were asking compensation expense associated with stock options. They're not asking that, so I'm not going to go through these questions. There will be nothing like this one on the exam. On our practice midterm coming up next week for all the chapters, I will show you some examples of calculating compensation expense for stock options, not for these, I forget what they call these things, share purchase plans. I'm not interested in those. Those are very rare. Stock options are more common, particularly here in the Bay Area, and so I will be testing you on that on the midterm. I don't have any here in the practice midterm for this week, specific to chapter 16, but I will have some on our practice midterm next week, and you will need to know how to do those kinds of questions by the time we get to the actual midterm. Okay, good. Let's take a look at couple more questions here. You know, I'm going to go ahead. I'm going to stop here and let you do these last couple because both of them are basic earnings per share, and I think you know how to work those, and so I think you'll be in good shape with those. Just remember to take off the, you know what, let's do this one. Let's do this first one, then I'll let you do the last one because there is a little bit of a wrinkle in this one. So let's do this 17. I'll let you do 18 on your own, okay? But let's take a look. At December 31st, 2020, Rice Company had 300,000 shares of common stock and 10,000 shares of 6% $100 par value cumulative preferred stock outstanding. No dividends were declared. That's the trick every time. When they want you to do the earnings per share, they tell you no dividends are declared. Doesn't matter when you're calculating the common shareholders earnings per common share number. Okay, so they go ahead and they tell me that nothing was declared. Doesn't matter. On January 30th, 2022, prior to the issuance of financial statements, there was 100% stock dividend. So I guess we already thought about that. So, but let's just take a look at this one. So we have what? $100 is the par. Number of shares, 10,000, right? And then 6%. So what's that coming to? 60,000. Okay, the net income is 1,140,000. You got to subtract off the preferred dividend from that, right? To get what's available to the common shareholders, and then. And we actually did talk about this. If there's a stock dividend and it happens prior to the issuance of the financial statements, you have to include that as though that stock dividend happened at year, during the year that you're calculating your earnings per share calculations for. So it was 100%, so 300,000. They issued 300,000 more, and then 100% stock dividend. You do the math on that, and you come up with 180. Okay, all right, and as I said, I'll let you do this one on your own, and you should be in pretty good shape with that one. Okay, guys, that's chapter 16. We've got chapter 17 to go. Then we're going to have our midterm prep week, and then we're going to have our midterm the week after that. So hopefully you're getting through all this stuff in pretty good shape, okay? All right, guys, see you next time.